So thanks again for everybody being on the call. My name is Rob Beardsley, founder of Lone Star Capital. On the call with us today is Charles Waldron, our director of acquisitions. He's going to help me share. Him and I have been working on this project for a few months now, where we've been more closely tracking all the data associated with our acquisitions. And we think this is a really worthwhile exercise to do to glean more insights from what you're seeing in the market to be able to make better investment decisions. So thought this would be a great topic to share with everybody. If you already are doing this in your acquisitions practice, then amazing. Would love to get your take on how you're tracking things. We actually just recently read a book by a well-known broker in the Southeast, Bo Berry. He wrote a really excellent book about broker relationships. And in that book, he had a very similar idea to the trade tracker idea that we have here, which he called it the love factor, which is basically you should keep track of all the deals that transact in your market. And then you should keep track of how many of those that actually you see from brokers or see directly. And, the higher that percentage is, the higher the love factor. So obviously for us, our love factor goal is 100%. I hate not seeing a deal and then seeing it trade. It rarely happens, but it's painful to potentially miss out on opportunity. But Charles and I, we stay on top of it. We cover mainly the Houston market. So the data that you're going to see today is predominantly coming out of workforce housing in Houston. But obviously this trade tracker concept can be applied to anything. So with that, Charles, you want to go ahead and share screen and we'll kind of dive in a bit more?
Yeah, thanks, Rob, for the intro. I'll just pull that up now. Let's see here. Share,
So before we dig into the specifics of the trade tracker, want to talk about why is this helpful? And, aside from being organized and seeing how many deals you're sourcing, I think it's good data for many reasons. One, it's testing yourself and asking the question, are you doing enough deal sourcing? I think some people get lazy with their deal sourcing. They maybe rely too much on brokers or wait for deals to come to them. And I think it's good to set goals and say, all right, well, I want to see this many deals per week. Or I want to underwrite this many deals. I want to submit X amount of offers. So what you see here is a sample of Q1 deal flow for us. So I think we put in about 50 deals. We probably underwrote, I don't know, closer to 100. And these are some of the more better deals, I would say, out of the lot, right? Because some deals, they don't quite make it this far. We just discard them after a quick underwriting. So those are some of the reasons, real high level reasons why we think this is a valuable thing to be doing in your acquisition practice. Another one that's a level down is getting market insight, really being able to know where cap rates are in the market for the type of deals that you're looking to buy. And then obviously we all know cap rate, but maybe some of us spend less time analyzing or being familiar with the market data for yield on cost, unlevered returns, levered returns, and things like that. So, and if someone on the call doesn't know what I'm talking about, like yield on cost or development spread and things like that, just feel free to ask and we can cover that. So let's start with, I don't know, Charles, you want to just give us some of the highlights, like how many billions or millions?
Yeah, right. Yeah, and it's definitely helpful. When you're looking at a deal, right? I mean, you got to be in touch with what the market is at if you want to actually be able to buy anything. At the same time, so while you want to make sure that you're actually able to be competitive and win bids, at the same time, you want to also make sure that you're able to get some perspective. And so when you compare them all to each other, then you're really able to see, how does this deal stack up against the other deals that we've looked at. So yeah, high level, I guess this document, which is a select portion of the deal flow, you can see we've got 61 deals in this tracker. Let me know if this is not showing properly or anything, but yeah, so 61 deals, of which 25 were marketed blasts. I'm sure there were more than that, but we don't look at every marketed deal, at least to this level. And then off market, 34 in this tracker. So that's actually pretty good balance there 14,000 units, whatever, over $1 billion, great. So yeah, so I mean, there's a nice slice of different deals here. I mean, you got all different sizes. Well, mostly over 100 units, but we've got a few in the kind of 50 to 100 range here. We got a 56, 93, all the way up to like 390, 362. I think there's a 964. So there's some portfolios as well. In the vintage, I guess it's average is 1980. So we are right there in the kind of BC workforce space, I would say.
Yeah, and Charles, you made a really good point that I've been kind of pushing for a long time, because the market's always changing and return expectations for investors really lag the changes in the market. So investors, they see historical returns, they're looking in the rearview mirror, and they're not looking ahead as to what is realistic, what is available, or what is more likely to occur moving in the future. So, for example, if you bought a deal in 2014, sold it in 2018, you, just generally speaking, likely got a better return than what is able to be reasonably projected out into the future over the next 4 or 5 years. So that's why, there needs to be some absolute investing occurring, but at the same time, and more importantly, you need to be a relative investor, and you need to look, like Charles said, at the market and understand, okay, here's the reality of the market. Here's all the deals that are available to me. And then rather than setting an arbitrary goal, like I want a 20% return, you should actually look at the market and say, well, I want a deal that pencils in the top 5% or top 1%, whatever your threshold is for deals, and then go out there, source, build the data, and then, go and transact on that top percentile of deal flow that you're interested in transacting on. So like Charles said, this helps us identify that. If we know realistically that most deals are, I guess here we've got the projected IRR at the guidance pricing from the broker is 10.4% IRR. That means you factor in your sponsor fees and whatnot. That's going to be like a 7. So just general market average is a 7% return. So that is not, that's not the 15 that most people think that if they just jump into a deal, that's what they can get. So we need to respond and be realistic in the market and say, well, if the market's offering us a 10.4, how much better than that do we want? And you can see, actually, yeah, Charles is highlighting here, cell Y92 and Z92, which is that project IRR. So like I said, the average IRR that we underwrote at the guidance pricing from the broker has been 10.4 in this sample. And the way that we underwrote it and the return that we demanded from the deal was 20.5. So that's where you can see our difference in price, right? So if they want 20 million and we only like the deal for 18 million, well, the reason why is because we're demanding a certain return hurdle that the market is not offering for that particular asset. So that helps us understand, maybe our 20 is unrealistic and we're just never going to find it. What I'll say is, and this is of course a small sample size, but out of this, 61 in the tracker, and we have one deal actually moving forward under contract out of this sample size. So, which is really great. If you're looking at a quarter, you should be getting a deal per quarter. And if you're looking at roughly 100 deals per quarter, going through this process, that's a pretty good hit ratio.
You can get one.
Yeah,
1%,
I mean,
yeah.
absolutely. So Bastian's saying, how did you source the returns for these deals? Are these all deals you underwrote? Yes. So yeah, Charles, we kind of jumped in. Why don't we go through it a bit? Why don't you walk us through column by column, kind of how we got this data into here?
Yeah. So we underwrite them in our model, and then the numbers get plugged in kind of per row. One underwrite in the model turns into a row here, and so and then as far as the IRRs, they're calculated in the model. So like we underwrite the operations the way we expect them to go, right? We underwrite the revenue the way that we see it makes sense, and we underwrite the the expenses the way we see it makes sense, and then the IRRs at our price are what that operational scenario gives at our price, and the IRRs at the market price is what If people in the market achieve the projections that we put out there, which, we try to be realistic, but also, to see the opportunity in things, that then, you're just going to project what's the IRR going to be if they pay the amount they're paying and they get the operations that we expect. And so as far as cap rates, the cap rates in the model are calculated using the NOI from our operational projections. So that's here in these yellow columns.
So the way that seller financials are, obviously, we all know that everybody runs their own deals differently, and taxes are different, insurance is different. And so all these NOI numbers are adjusted by our forward expenses. So what we do is, and this is the way that we underwrite standard to derive our adjusted cap rates always, is we'll take the in-place revenue and subtract it by our budgeted or forecasted expenses. And that includes adjusting the taxes upward. Typically taxes can, potentially go up 20%, 40% upon a sale. And that is already factored in here in our cap rate. So just because the seller might say, oh, well, I've got a 7 cap here, when we underwrite it and then we put it here into this data, it might be a 4, it might be a 5. And so that's adjusted for. And then similarly, our pro forma NOI, which you see is column AI, is simply, again, our budgeted expenses, but now it's our future revenue. And then, of course, you can't get to future revenue without CapEx. So we pull in the CapEx assumptions that we have for the deal as well, for that column AJ. So anything else to add there, Charles?
Yeah, I mean, I think that, yeah, we're having a realistic assessment of like the kind of yield it's going to actually be achieved once you put in kind of professional management or whatever. And some properties have more headcount or more management expenses than we're going to have, and others have less maybe, in the owner's financials. But, maybe you generally are able to run properties for cheaper than Lone Star is. And looking at our tracker, you're actually still able then you can know that you're generally going to be cheaper than us. Whereas, the owners ones aren't comparable to each other because like some are going to be, higher on the cap rate and others are going to be lower on the cap rate. Then this kind of makes it more comparable to each other by using a similar expense projection for all of them.
Yeah. So that's the apples to apples thing. Like, you might disagree with the way that we underwrite, which is perfectly fine. Nobody should underwrite exactly the same. We should all have our own unique viewpoints on deals. But by having, whether it's this tracker or your own personal tracker, you should have your own expenses in here and your own assumptions uniform, because that allows you to compare apples to apples. Again, we can be relative investors, not absolute investors. So at the end of the day, whether we're solving for a 14, 15, 16, 18, it's not as relevant as the fact that we're pursuing that top percentile of deals. And then we can quantify that through the data here. So, and it's always changing also, right? Because prospective returns go up and down with the market. So a top 1 percentile deal might be a 20% IRR today. And then, 5 years from now, that could be a 15. Who knows where return trends head. So Charles, we have a question from Jack who's asking, for the average IRR, would it make more sense to weigh it based on the deal size instead of just a simple average?
Yeah, I mean, I think it could. We're just starting out with a model, and so I think that makes sense. Although, at the same time, if you were to do that, you would probably also you would just lower it, because like the larger the deals are, the more competitively bid they're going to be, the bigger money, the bigger equity checks are going to have a lower return hurdle generally, just because they have to. So, I mean, I don't know. I guess there are arguments both ways, and we'll have to think about that some more.
I think a good approach, and there's just so many ways you can slice up this data, but to Jack's point, what you could do is you could sort the deals by size, and then you can look at the returns and you can see, is it actually true that the bigger the deal is, generally speaking, the returns get lower because there's more institutional competition and they have lower return hurdles, right? That would be one way to manipulate the data to get some insight.
Yeah, we could. Yeah, it's interesting. Yeah, definitely. I think something worth following up on.
So let's talk about let's start with cap rates. It's something that we're all familiar with, and we can see that basically am I reading that right? The average cap rate that we underwrote here is 4.1%.
Yeah, the guidance.
Yep. So at the pricing guidance that, basically the whisper price or the strike price that we get from the broker, when we underwrite the deal and put it, adjusted for our expenses and taxes, we're coming up with a 4.1% cap rate. And that makes sense because Houston is a primary growing Texas market, and we are typically looking at value add deals. So there's embedded upside. So you're paying a compressed cap rate for that upside. Another thing to mention is anecdotally, we don't quite have the data for this yet, but anecdotally, we're seeing that many deals that are going through a full marketing process today are actually selling for over the pricing guidance. No longer is it good enough to come in with a bid at the asking price. You actually have to exceed the asking price to win. So we're seeing that get even more competitive. So these guidance prices doesn't even mean that this is actually the cap rate in the market. So as we get more data here with where deals actually close, then we'll be able to update that, and we can actually track the difference between the pricing guidance, underwriting and data versus the actual trade value data. So so that's the cap rate, and you can see if you look at. Oh, it looks like the screen got a little fuzzy.
Sorry. Here we go.
No, it's still fuzzy.
uh,
So,
is it back?
nope.
Okay, I think it has a lag because
If you have to, you can unshare and then reshare. But what I was going to say is you can see the Lone Star column a few over. Yeah, Charles, it's still fuzzy.
It's
Okay,
good
so
for
I'm just
me.
sitting still in the same Excel window as before. Is it still fuzzy?
Okay, so it's just fuzzy for me.
Well, do other people see it?
Hold on, here we go. All right, I'm back. It's just me. All right, thanks guys. So sorry about that. So okay, by the way, Charles, Raj is asking, can we share the spreadsheet? No, we cannot. Actually, could we share it without just taking out
I don't know. I mean, we have to think about that. I think. I mean, some of our
we got
brokers will not be happy with.
we have hidden data in here that is more deal specific sensitive, but we maybe can take it out and then share it with you guys. So everyone on this call that registered is going to get a follow-up email with a recording of this. So if Charles and I do find a way to share this information, which I think we can, it'll be included in that email. So look out for that. Okay, so basically I explained the cap rate, and then okay, Raj is now saying it's still fuzzy for him. Okay, so we'll work on that. But so what you can see is 4.1 is the cap rate for the pricing guidance, and then 4.5 is the cap rate that we actually at our price that we'd be willing to buy it for. That was where our underwriting came in at. So it doesn't seem like a big difference, 4.1 to 4.5, but it really is a big difference. It results in, as you can see, the IRR going from 10.4 to 20.5. So that's actually really crazy. We double the levered returns just through a 40 basis point increase in going in cap rate. So I think that's one of the reasons why, like, exit cap rate, for example, is so easy to play with, because you just change the exit cap rate of a few basis points here and there, and it can really change your results. So, and here you can see firsthand that change actually resulting in levered returns so substantially. So the next columns are yield on cost, the YOC. And so we have yield on cost at the pricing guidance and yield on cost at our price that we would pay for the asset. And you can see the average that Charles just pointed to for yield on cost is 5.6%. And if you're not familiar with yield on cost is the pro forma NOI divided by purchase price plus capex. So it's basically, it's like it's your future operating cap rate, and it factors in your capex budget to get you to that future NOI. And it's like a cap rate on steroids that really tells a lot more about the deal. What it misses about the deal is it's untrended, and it doesn't tell you how long it takes to get to that return on cost, and it doesn't tell you how much risk is required to get to that return on cost. But you can see basically the typical deal on market, you would pay a 4.1% cap rate, and then you would go through your value add, and then you would push that to 5.6% cap rate, which is a 1.5% spread. Now that spread is indicative of obviously your lift. So how much increase in NOI you created as it relates to your cost basis, right? Because we have to factor in, we're including CapEx here. The important thing to understand about the spread is it is an indicator of your business plan and a measure of risk. So the bigger the spread, the bigger the risk there is of implementing that business plan. So, a really small spread of, let's say, just 50 basis points, that's a core plus deal. You're not really pushing the cap rate too much, or altering the deal very much. So that's a low risk play. Now, a really interesting takeaway that Charles and I got this morning when we were looking at this data beforehand was this idea that the lower your going in cap rate is, the greater your yield on cost needs to be, or the greater your spread needs to be. And that obviously makes sense intuitively, but it's the idea that the less income you buy going in implies greater risk of your needing to raise the income and stabilize to a higher yield on cost. On the opposite, if you buy a good cap rate today, that means you've bought well at a low basis, and you get to enjoy a good yield right off the bat. You don't need quite as much lift, from both a risk adjusted return standpoint and just a simple spread, to make that deal make sense, right? Just logically speaking, if I could buy a deal at a 5.5 cap today, I'll accept a low teens return on that deal. Charles, why don't you also mention how certain things can affect the cap rates and yield on costs, like loan assumption?
Yeah, right. So I mean, if you're gonna have so in some cases, like I think this one here, but in any case, in some cases, there'll like be a loan assumption, for example, and so then you're going to need to have like your cap rates will look great, but like that's because the cap rates aren't including the loan, right? So like your actual cash flow from that cap rate is going to really be bad. So I think this. Okay, so here's one. So 5% amortizing assumptions. I mean, looks all right. Well, actually, that doesn't even look good. I think this one. Here we go. Here's one. So this one here, is underwriting to like a 7 capital. We want it and a 5.8 at the guidance, which is, really tremendous as far as like if that were available free and clear. But, keeping in mind that you're assuming a loan, and I don't have the details on that in here, but I'm guessing it was, not a pretty loan. And, that's just going to crush your cash flow, like once you put that in. And so, not all the cap rates are necessarily just kind of immediately, what they appear on the surface.
Yeah. So assuming ugly debt at a high interest rate is obviously going to force you to need to buy at a better cap rate than what is available in the market. So, I mean, we don't have a ton of loan assumption deals in here. I mean, there might be 10 out of 60. So that's a good amount, but that would skew our cap rate data upwards. So how do we, normalize for that, or really, take that out of the equation? It would simply be looking at the project IRRs. That's going to be your cleanest and purest way to evaluate the deal, because obviously your IRR is going to factor in the assumed financing and those reduced cash flows. And you're likely going to need a slightly higher IRR out of the deal to justify those worse cash flows in the interim when you're dealing with that assumed loan. So, as we touched on before, the project IRR versus the strike price versus our pricing is a whole 10% difference, of 10.4 to 20.5. And like I said, we just started doing this is our first quarter of tracking this data. So it'll get better. Our insights will get better. And I think one really cool thing to do would be to, basically arrange returns in percentiles and come up with, we could be able to definitively say this X percent return is this percentile. Unfortunately, what is missed when we look at that equation is risk, right? Because all these deals here don't have the exact same risk profile. They don't have the exact same growth prospects and things like that. So, just because one deal has a 20% IRR and the other has a 15 doesn't mean you can directly compare them if their risk profiles are different. So that's something that we haven't thought enough about or haven't solved for, but is nonetheless very important. Bastian has a question about, do we capture in the tracker how much the property actually sold for? So yes, we do. We're hiding that data because we don't know how, if we want to share that more like proprietary data, or if our brokers are wanting us to share that information. So, we want to hide the names of the deals, the brokers and all that stuff in this, but we do keep track of all that. And that's a little bit more work because obviously there's a long lead time between when a deal is initially being marketed and then to when it actually sells.
Yeah, I mean, a good number of these are still in, certainly they won't have closed even if they agree to price.
Yeah, a lot of these have not closed, right? So Jack's asking, how do you guys gauge market cap? Well, what does that mean? Or, more specifically, I mean, you can see, how do we gauge it? Well, it would be through this data. We're looking at deals all day long and we can see our underwritten cap rate on average is a 4.1%. So without understanding your question a bit better, that's all I can say is, the market cap rate is 4.1 for these types of deals. But again, it's 4.1% for what kind of deal? Most of these deals that we're looking at are value add, so it skews the cap rates down. If we were looking at stabilized assets, it would push the cap rates up. If we were looking at class A, it would push the cap rates down. So there's, it's not, I don't want to say it's meaningless. It certainly has meaning, but it's really hard to just say, here's the market cap.
Yeah, I mean, even at the top end of this, though, we do have some more stabilized deals. You're only just getting above 5 a lot of the time. So
Yeah. So people who, come to you and say, oh, I have a great deal, it's a 5 cap, it's almost impossible for that. I mean, not impossible, but it's really rare for that to actually be the case.
well, I
So
mean, or if someone's like, "Oh, I've got a," I don't know if anyone's still saying they've got a 6 or a 7 cap these days, but that does seem to come up once in a while.
yeah. So I think one way that looking at this information has helped us is get more confidence behind our exit cap rates. So one thing that we've realized, and one way that we think the market has adjusted over there, I mean, has continually adjusted downward, is the exit cap rate. But I think even more recently, with all the change in global flows of capital and interest rates and the Fed policies, I think you're seeing people getting more comfortable with underwriting to lower exit cap rates. And, frankly, so are we. So that's how, one of the ways that we are adjusting to the market. And having this data here and seeing, what real cap rates are allows us to actually more confidently price our exit cap rates, which, like I say all the time, your exit cap rate should be based on the market cap rates, not on your going in cap rate. Because again, if we're buying a heavy value add at a 3 cap, that doesn't mean I'm a conservative underwriter if I exit to a 4 cap, basing that, 1% increase to the exit. That's not what we're looking for. Raj is asking, if it's not much of a segue, can we comment on the upsides and downsides of core versus core plus, how capital markets view such deals? Well, so we maybe have a sprinkling of, well, let's look at, Charles, can you sort the spreads and let's look at the deals with the lowest lift. So, basically the question is, what are our thoughts about core versus core plus deals, which are deals which don't have much of a value add business plan, not a lot of renovations, not a lot of risk. So as you guys might know, generally speaking, we're looking for deals where there's high vacancy, low rents, bad management, deferred maintenance, and those are value add deals. And a core plus deal, you're taking less execution risk because you're aiming to buy in place yield and then derive more of your return from yield rather than through creating value through your business plan. So you can see here we do have not a ton of deals actually, but some deals that you would call core plus that are, really we're buying in place yield. And I think those are I think that's a great strategy. Right now, generally speaking, if you can take less risk than more risk, I think that's the right approach because typically you're not getting paid a risk premium for taking more risk in today's market. The risk curve is very flat. But with that being said, the classical core/core plus play that more institutional investors think about and do is investing in CBDs and in top tier submarkets. And that is something that we are not fans of, at least in our market of focus. So, Charles, you want to comment on kind of the dichotomy between core markets and then what's actually happening in real life?
Yeah, I mean, we've been speaking with some investors, and they're kind of like, oh, well, Houston, we feel it's got, we own in some really good areas in Houston, and the rents, where it's not going the right way. And it's like, well, yes, because those places where the rents are higher, also where all the development is. And so, especially with COVID and everything, those people have not been doing so well as far as rent growth. And then on the other hand, like some of the workforce markets where you have like the renter by necessity and all of that stuff, and it's more affordable to begin with, you can still see at the very least rents holding on and, maybe even going up. So like, if your plan is to buy core plus in the CBD, for like your stability, I mean, you might not see that if there's development. And on the flip side, you might see in like kind of more, what you might expect to be like a value added type area, you might still have actually steadier rent growth.
Yeah. So, like I was saying, the more classical idea of a core investment would be, a building that was built within the last 15 years, within the last 10 years, and it would be in a more affluent submarket with 100K plus incomes.
Like River Oaks downtown, this sort of thing.
Yeah, for Houston, you've got Galleria, River
Penta.
Oaks, and like Charles said, there's just a ton of development. Any place that across the country where it makes sense to build and the incomes are high enough to justify development, there's just a ton of new supply, and for the most part, it's keeping rents from growing and pushing them to be negative. So I do like the core plus strategy, but I would focus that core plus business plan in a more, like Charles said, value added location, more workforce housing, 50,000 incomes, slightly older property. So you have to take, vintage risk by buying older assets. Typically, I mean, if you can find maybe a newer property in I would say workforce area, that would be also a good core plus strategy. So yeah, so those are our thoughts. But as you can see, we don't end up underwriting a whole ton of core plus, and the reason is the absolute returns are lower for core plus, but also I think the more important realization or reality of our market today is, when's the last time that you saw a deal that didn't say value add on it? Yeah, the reality is every deal being brought to market, even if it's I was just on LinkedIn, renovated in 2020, value add deal, right? So every deal is a value add and it's being priced accordingly. So it's not like people are coming out with a core plus deal and saying, oh, this is a core plus, we'll sell it to you at a slightly higher cap rate so that you can get your yield. No, that core plus deal is going to be masqueraded as a value add, and because they want to sell at a 4 cap, just like all these deals that we're underwriting. So the key in this market today is actually to go sift through all the value add deals and find the ones that really truly are value add and that have that realistic ability to push revenue, reduce expenses, and end up at a yield on cost that is at least, I would say, 50 basis points, preferably 50 basis points in excess of your exit cap rate. Charles, why don't we talk more about kind of development spreads and yield on cost and exit cap?
Yeah, I mean, I think we want to, so, it's less important necessarily what cap you buy at than what the difference between the cap that you buy at and the cap that you sell at, right? I mean, if you can buy, a 3 cap and sell it at a 2 cap, I guess that'd be great. And so, but by doing the value add plan, you're able to buy that lower cap rate and create that value, and so that, allowing you to sell at what is effectively, you can put a better valuation on the income that you bought.
Yeah. So to me, this is, and you can see some of the most sophisticated investors around the country talk about the most purest way to evaluate a deal is to look at that development spread. And development spread is your yield on cost subtracted by your exit cap rate. And so so what we don't have in this data set here is our exit cap rates that we use to underwrite the deal. So I think in the future, we'll probably incorporate that so that way we can see what we're typically basing our returns on, because exit cap rate is such a fundamental part of your analysis. So, but anecdotally, what you can see here is on average, we have a yield on cost of 6.2% on our pricing. And what I'll say is, so we got 6.2, and I'd say just on average, my guess is we probably used a 5.75 exit cap most of the time across these deals. So that brings us an average development spread of 45 basis points. And so that 45 basis points is usually enough to generate a solid enough return, especially if you're investing in growth markets. So really the factor that determines how much development spread you need is the risk of the business plan and then the growth prospects of the deal, right? If I'm buying in Phoenix and rents are growing 10% every year, then if I buy a 4 cap today, it's going to be a 5 cap next year and then a 6 cap the year after, and it's going to keep going. And so I can afford to actually pay a 3 cap because of all that growth that's going to happen. So my development spread doesn't have to be quite as big. My development spread may only have to be equal to my exit cap, right? So I buy it, raise revenue just a little bit, and then it equals my exit cap. But then over time, it grows and grows, and that's where I actually create value for the exit. So that's something really important to focus on, and a really good way to sanity test the deal, right? Because after you layer in financing and growth and IRRs and this and that, you might lose sight of the deal. And a really quick and easy way to look at the real return potential of the deal is just to look at your yield on cost and your exit cap rate. Anything you want to add?
I think that was pretty comprehensive.
Okay, cool. So yeah, I mean, I guess that's pretty much it. This is what we put together so far. Like I said, we just started doing this. We think this is worthwhile, to say the least, and we'll keep building upon it and getting more data. So, to wrap up, if anybody has any questions or wants to take the conversation in a different direction, we're ready to open it up. Mendy asks, how do you guys plug in the number? Is this automated? Well, Charles wishes this was automated.
Yeah, it's not.
Charles, you can quickly explain, maybe for some people that joined late, how some of these numbers find their way into the sheet.
Well, yeah. So again, as I kind of said at the beginning, but so they come from the underwriting model. Not every cell is input, right? So the the ones that are yellow and red are input cells. So we'll input like the unit count and the guidance and the pricing. All of these cap rates are calculated just using the NOI we put in and the prices. In conjunction with the capex. So it is some manual input, but it could be, it's actually quite a lot of calculation as well that the sheet does. So
yeah, and for those that maybe joined later, missed it earlier, every row here is a deal, and every deal has a full underwriting spreadsheet. So it has a full model that has income, expenses, debt assumptions, sale assumptions, growth assumptions. So each row is a full underwriting, and then the summary of that information is reflected here. Bastian's asking about deriving reversion cap rates using this data. So it's a good question. And like I said before, in my opinion, the wrong way to derive your exit cap rate would be to look and see the average going in cap rate based on the guidance price, and we'll call that the market price, is 4.1%. And then everyone has their own benchmark. I would say most commonly today, people are, say, widening their exit cap by 50 basis points. So if you could take that 4.1 and then push it to 4.6, and then that will be one way, in my opinion, incorrectly to derive exit caps based on this data. Now, as many of you might know, if you use a 4.6 exit cap on a lot of these deals, they're going to look like total home runs, 30 IRRs. So that's clearly not the right way to go. So the right way to go is somewhere in the middle, and it actually requires evaluating stabilized deals. And so if assuming you're buying value add, so the unique part is you have to understand if you're buying a value add deal, and then when you're finished with your business plan and you're going to sell it in 3 to 5 years as a stabilized asset, those are two fundamentally different deals, and investors will value them differently. So it's important to have relationships with brokers and underwrite deals that kind of fit that stabilized criteria if that's what you're looking to sell. And so I would say today, what we're seeing is stabilized deals that really don't have much meat on the bone, or opportunity to push that yield on cost. I say those are typically trading in the high fours, low fives. And so that means if you're a conservative investor, you should widen that market cap rate, high fours, low fives, up 50 basis points to get to your exit cap rate. And so generally speaking, that's around what we're doing. And, here and there, it's starting to work for us.
I mean, that kind of assumes also, that they are what they say on the tin, right? I mean, everything is a value add. So, you could value add and, I mean, we wouldn't project this, but, a lot of the time you'll see a client, this is a value add too, and they'll try and sell it for a 4 cap.
That's the magic. Exactly. So, we might buy a value add deal, like Charles said, do our business plan, and then 5 years down the road, when it's time to sell, we may not think there's really any meat on the bone, but the broker might do a heck of a job marketing the property and might sell it as a value add where the buyer will pay a below market cap rate. And obviously we don't underwrite that way, but that is obviously a big win. And that's what you're seeing most of the time happen today. Another question is, what is your ideal hold period for these during the underwriting process? So the vast majority of these deals that you see in this tracker here are underwritten on a 5-year hold. And so our general practice is for deals that are largely stabilized and financed with permanent debt, we use a 5-year underwriting. And for deals that are bridge, where we're using likely a 3-year bridge loan, we underwrite to a 3-year hold. And that's really, we don't make it any more complicated than that. We know that investors, generally speaking, like to see the 5-year hold. So we're biased towards that as well. Okay. Well, awesome. We'll hang out for another couple minutes for any questions. Otherwise, this pretty much concludes it. You guys can jump off if that's it. So again, appreciate your time. Thanks for being here. Happy to share this, and always appreciate these being more collaborative with questions. That way we all learn stuff. I'm always learning on these things, and let's keep them coming. Another question coming in, Raj says, any upsides or downsides of long-term hold, say like 10 years? I would say, I mean, that's a huge conversation, between buy and hold versus sell and whatnot. Generally speaking, if you're able to effectively implement value add plans, then the highest and best use of your capital is to get in, implement your value add, and get out, and continue to do so over and over rather than get in, value add, and hold. But it's easier said than done. So you can try and be unsuccessful. And meanwhile, a long-term holder could actually end up with better returns. So it's obviously more risky, generally speaking, to hold deals for shorter and try to churn, but it leads to higher returns. So Sorry, Charles, did you have something to add?
Well, I guess I thought was kind of, I mean, I think it, it depends on your equity obviously as well. Like, it depends if you have 10-year money, and also I think there's a trend in private equity, more buyouts now also where like assets will be put in like the kind of the buyout fund, they'll be moved into a follow-on fund. So like, when you're doing the value add, some investors want that like risky value add with the higher returns. And then like your other investors will want the stabilized product, and so maybe, that's another option, but yeah, probably not typically available here and now. But
Yeah, yeah, exactly. And being like, being in the private equity world, being a syndicator, and having a promote interest in these deals pushes you to want to sell. So from our perspective, no matter how much, we want to, no matter how much we love a deal and want to hold, if we as the sponsor are sitting there with $1 million promote, that's going to weigh on our decision to sell heavily. So that is another reality. It's difficult in the traditional private equity structure to really actually do a long-term hold. Sponsor wants to make their money. Investors don't mind getting their money back most of the time. Mike's saying, will we be posting this soon? Yes, this will be on YouTube later today, and you'll get an email with the link to the email, and we'll also no promises, but hopefully share this spreadsheet with you as well. Please take the sheet if we do send it and make it your own. Change up the formulas, add columns, add more data, different types of data, and make it better and give us that feedback. We'd love that. Tyler's asking a really great question about growth assumptions and them, rent growth versus expense growth. Do we make them the same, or is there a difference? So generally speaking, we have them both at 2%, which just basically is inflation. But for better quality deals, better quality areas where we think there's a greater chance of positive rent growth to occur, then we'll underwrite to 3% rent growth and 2% expense growth. But we don't go any higher than that. If we were in a market like Chattanooga, Vegas, Phoenix, then who knows? Maybe we'd be at 3.5% here and there, 4%. I don't know, but I'm sure
five,
that's how
four, four, three.
that's how people in those markets are getting deals done. Otherwise, your bid's not going to be competitive. So, but that's how we work, and that makes us feel more comfortable. I'm less comfortable chasing growth, if you will. Chris is asking, do you believe we should adjust exit cap as cap compression continues down and potential changes in investor appetite? Yes. So 10 basis points per year, I think is, more so, I mean, it's reasonable, but it's on the maybe slightly higher side for today. I do believe in the continuation of the secular downtrend of cap rates. In the short run, will the 10-year go to 3%? It very well could. I think short rates are going to stay low for the next 2 to 3 years. So, nobody knows, but as an investor, if you, frankly, Chris, if you don't take that angle, because enough investors are, you're going to miss out on deals and you're not going to participate in the market. I know some very smart investors who have been very successful, and they today are sitting on the sidelines because they think cap rates are going to go to 7%. And if you think cap rates are going to go to 7%, there is not a single deal out there that you could underwrite and include that assumption and for it to still look good. You're just going to sit on the sidelines. You're not going to invest, which is not wrong. I mean, we'll find out if it's wrong, but that's just the reality of the market. So Jackson's asking, how aggressive do you get when forecasting exit cap? Increase market cap by 2 basis points. So now we've got 2 basis points per year. So yeah, I kind of answered that already. I mean, I think like roughly around 50 basis points above market is reasonable. I think that's very defensible today. So I'll leave it at that. I don't like the basis points per year. We never do that, because I don't know. It's not the way.
It's not a law of the universe that that's going to happen or anything. So I mean,
Yeah. People say that because they say, well, real estate depreciates and the property gets older. And it's like, well, people are paying for 1960s deals, low cap rates, just the same as they are for 80s deals and 2000s deals. So I don't, that part of the equation of, well, you should widen your exit cap rate every year because the property gets worse. No. But what I will say though, along those lines, is most people don't budget enough ongoing replacement reserves and an ongoing capex. And so, they end up underfunding that portion of the deal. And that could lead to accumulated deferred maintenance, or it could lead to below that, less than expected cash flow. So that is a reality, but cap rates, no. All right. I think we're going to wrap it up here. Thanks everyone for sticking around to the end. Really appreciate all the great questions. Super great. Look out for the email that I'll be sending out later today, and hope to see you guys on the next session soon.